I'm sure, will not have come across the name Team Internet Group PLC before. And one reason for that may be that for the first 10 years of the group we work for's life as a listed group, it was called the Central Nick Group. And it was in September of last year that we rebranded Central Nick Group. In fact, on the 10th anniversary of Central Nick Group listing on AIM, we rebranded the group as Team Internet Group, and it's the Team Internet Group that we're here today to describe, but many of you will know Central Nick from previous presentations. So Team Internet is now the new Central Nick, following 10.5 years now of life as an AIM listed group.
So as Billy described, we were originally known as Central Nick Group, and currently that maps to one of the two divisions that we split our business into. Our far larger division is the online marketing business, which is basically a way that we develop to connect users of social media to advertisers that are part of Google's ecosystem. So this has been a very fast-growing part of our business. On the right-hand side, we've highlighted how many different consumer journeys we've taken people on. In 12 months to September 30th, 2023, so 5.6 billion consumer journeys took place on our platform. The online presence business is the embryonic Central Nick activity. And here we really act as a critical constituent of the web ecosystem, where we supply domain names to users and registrars such as GoDaddy, Squarespace, and we're a key element of the internet industry. In terms of revenue splits, we are quite global. About 51% of our revenue is generated in the Americas, with bulk of that being in the US, and 49% comes from the rest of the world, with a heavy skew towards European consumers. So I wanted to spend a few minutes talking about the online marketing division and really indicating some of the mega trends that underpin the spectacular growth that we've seen over the last couple of years. So more and more companies are advertising online. More and more businesses and services are basically advertising and providing their services exclusively online. And we use our platform to connect them with potential users. So we acquire traffic on social media platforms such as Facebook, Twitter, TikTok. We qualify users' interests, intentions, and we deliver them to Google's ecosystem of advertisers. And why does this work? More and more people are spending time on social media. We see in the statistics that come out year after year that people increasingly spend time on those platforms and spend more and more time on those platforms. Whereas the advertisers prefer the high intent targeting of Google. So if I go into Google right now and into a prompt type in cheap flight Miami, there is a clear indication of what my interests are. I'm looking to travel, I'm going to Miami, and I want it to be at the budget end of the spectrum. And this is perfect information for advertisers because they can very easily target me knowing this information and provide ads that are most relevant to what I'm looking for. However, all the users are on social media. And there, the onset of data privacy means that increasingly their social media platforms are able to provide less and less information to advertisers about the nature of the users, which makes the advertising on social media less attractive to end users. And some examples of why this has come about stem from the end of in-app tracking for iOS. So this was where your telephone really was looking at all your activities online and passing that information between apps. And so then when you opened Google or Facebook, the advertisers knew exactly what you were ordering, what you were interested in, and could give you very highly targeted advertisements. And with the onset of GDPR, as well as other legal developments in California, for example, we've seen that the social media platforms are able to provide less and less information to advertisers and are able to track your behaviors to a far lesser extent than previously. What Team Internet does is, through our product Tonic and Parking Crew, we create a bridge where we take the consumers that are spending time on social media on a journey on our own platform, where we're able to really assess their interest and conviction, determine what would be the most appropriate advertisements to match that, and provide them with an ad from Google's ecosystem. So this is really these two trends, social media dominance and data privacy, have underpinned our spectacular growth over the last few years.
Thanks, Martin. So in terms of some of the platforms we operate, the main platforms that Martin's referred to so far, you'll see at the top right-hand side of the page, Tonic and Parking Crew are the two platforms we use to take consumers, to take traffic, what are referred to as eyeballs in the advertising industry, to take that traffic from social media or other broad media sites and to deliver them into Google's advertising ecosystem. So Google has the advertisers at their disposal. Google has the network, the portfolio of advertisers who are keen to spend money. And even with the vast amounts of traffic that naturally hits Google's websites each year, Google.com, Google.co.uk, and Google's other proprietary websites, even with the huge volumes of users who use Google, they still don't offer Google enough traffic for Google to be able to fill all of the advertising dollars that advertisers want to spend with Google. And that's where we come in. We are also a provider of traffic to Google, so that therefore Google can take the traffic from its own websites and also add that to the traffic we're providing that we've scooped from other areas of the internet that Google can't touch. And then it combines both those traffic sources together in order to give their advertisers as much quality traffic as possible. And we use the word quality quite carefully, because one of the reasons why we have gained market share over the years and become more and more adept at being what's quite objectively Google's largest business partner in terms of their AdSense for Domains network, and AdSense for Domains is the name of the license that we have in order to provide traffic to Google's advertisers. One of the reasons we've become better and better at that is because the amount we've invested in the quality of the data that comes through our platforms, through Tonic and through Parking Crew, are subjectively, I would say, they're unrivaled. They are at very least in the top 1, 2, or 3 in the world in terms of the quality of the traffic we're delivering and the filters. I mean, you've probably all heard of spam clicks and robotic clicks. Our systems are well developed to filter out that kind of traffic, so that we can be sure that when we're delivering traffic, consumers to the advertisers, that's a real consumer that's hungry and ready to buy. The other platforms that are referred to down the rest of the page, the 3 other blue dots you'll see there, Vergleich.org, Volume, and ZeroPark, they are other advertising technology assets. So they are other slightly smaller. They're not at the same size, they're not at the same scale as Tonic and Parking Crew at the moment, but they all have individual development stories where we're looking to develop them so that one day they may rival Tonic and First Parking Crew in terms of size. The 2 green dots you'll see there, I mean, they're supposed to be green, they look more yellow on that screen, I have to admit. Those 2 lighter coloured dots, CentralNic Reseller and CentralNic Registry. You remember I said at the start of the presentation that we as a group started life as CentralNic Group PLC. The legacy Central Nick Group was a domain name procurement and distribution business, so quite a different industry to the advertising technology businesses, Tonic, Park and Crewe, Vergleich, Volume and Zero Park. We still, although the name Central Nick is less relevant to the digital marketing business that we've developed to become over the years, the name Central Nick is still relevant to our online presence segment. So therefore, we retain the brand name Central Nick Reseller and Central Nick Registry to use within that domain name sector, which some of you may remember from Central Nick from the last 10 to 15 years. The company's been going 10 years as a listed group. So the online presence segment now represents, as of today, online presence represents somewhere between 20 to 25% of the group, but we generally focus more on the online marketing side of the group because materially, if you're interested in the group as an investor, you have to be comfortable with the online marketing model. You have to be comfortable with the media industry in general. And I'll be frank, a lot of people will be nervous of the advertising, the media industry in general, because it is quite cyclical. I think nobody who works in the media would claim otherwise. It is quite cyclical. There are periods of relative growth and decline within the media ecosystem. 2021 and 2022 were years when our online marketing business grew at a, frankly, phenomenal pace. I've never worked in a business that showed such significant double-digit revenue growth, or organic revenue growth at that. 2023 was a year of more moderate growth in online marketing and in the global media ecosystem in general. We're currently looking for signs that the online advertising industry, the online marketing industry, is ready to really boom and grow again. As an overview of the revenue figures, so revenue is on the right-hand side, and that's our cost of sales and indeed gross profit on the left-hand side. So just to illustrate what we've been talking about, the scale of the business, you'll see if you combine the search, e-commerce, and affiliate advertiser portions of our revenue, you'll see that constitutes the online marketing part of the business, whereas from resellers downwards, that represents the other 20% of our gross revenue. So it's important for me to state that although the online marketing side of the business is about 4 to 5 times the size of the online presence side of the business, that's not because the online presence side of the business has declined or failed to grow in the last several years. The online presence business has actually grown and developed every year. So if you went back to the time when I joined the company, 2019, online presence revenues were significantly less than the 171 million we recorded for the 12 months ended 30th June 2023. So the online presence segment has grown, but the growth of the online marketing segment, as I said, in 2021, 2022, its growth just outpaced the online presence side of the group. If you're the kind of investor who likes a relatively a more diverse portfolio, Team Internet does give the opportunity within one listed stock to have two quite different speeds of business. The online presence business operating in the domain name space is more of a slower growth, steady, highly recurring revenue, or highly contracted recurring revenue. Some people describe it as a cash cow, which I would decline. I would decline that particular label of our online presence segment, because a cash cow typically is just used to fund another part of the group, whereas actually the online marketing part of our group, even though it's high growth and it's more cyclical, it does generate a lot of cash in its own right. So online presence for us is more than a cash cow. It's actually a really living, thriving, organic part of the business that, although it happens to be smaller than online marketing, because online marketing grew at a faster rate, I'll hopefully have a bit of time to come on to what happened in 2023 for these two parts of the business, because online presence actually had its best growth year since before I joined the group in 2019. So it's a very good spot at the moment for online presence. And the online marketing cycle, whilst online marketing and the ad tech industry in general does keep growing, 2023 was not its biggest growth year. It was its biggest year in terms of absolute dollar value, revenue and profit, but the growth rates were higher in 21 and 22, and we hope following a year of mid-teen digit growth in 2023 that we'll see higher growth in 2024 and 2025. I will skip forward, conscious of time, and I didn't want to go into the business models in too much detail, onto the financial highlights, because we don't release our 2023 annual report until the middle of next month, so we can't talk to you today in too much detail about 2023's financials. Monday the 18th of March is the date on which we are aiming to release, and we've set up various calls and investor outreach for Monday the 18th of March when we release our annual report. But we've got in the habit the last couple of years, because March, April time is quite a long time for people to wait for results. We usually release financial highlights and an earnings release in late January each year. And on the 29th of January this year, we released, I mean, it's almost literally these numbers on one page. It was 6 or 7 numbers, just the highlights of what happened in 2023. And just to run through very briefly the highlights we released to give you an idea of what kind of year 2023 was. Top left-hand corner, you'll see gross revenue grew at a rate of 15% from 2022 into 2023. So 15%, although that is a fantastic rate of growth that a lot of businesses I've worked in over the last decade or two would kill for that level of growth rate. In practice, that's our lowest level of growth for quite some years. So 15% is really the minimum that would be acceptable for us for 2023. So although we were so 2023, I would characterise the years that were satisfactory rather than really groundbreaking. Net revenue growth and net revenue is the term we apply to gross profit. Other companies within the online marketing industry, within the ad tech industry generally, a lot of them tend to be US listed, and they use the term net revenue instead of gross profit, or interchangeably. Net revenue is the term they use just because it's revenue net of pass-through costs and traffic acquisition costs and partner shares. But to us, UK investors, that's gross profit. So net revenue or gross profit with 190 million. You'll see that grew by 7%, and naturally we expect to be asked the question, why is gross profit growth lower than gross revenue growth? And that's not because any particular revenue stream is showing a deterioration in margin. It's more to do with mix between the different products. There are from time to time decisions that we make as a business where we have to decide whether to accept some lower gross margin business. But if we skip forward to the top right-hand corner, and it's particularly important to Martin as Head of Investor Relations, to myself as the CFO, that when we are making investment decisions about whether we will accept lower gross margin business, it's very important to us whether we can do so without investing too much additional OPEX, so that we can still be sure that we're able to deliver higher levels of operating profit or EBITDA than we are net revenue. So it's quite pleasing to us to see that even though net revenue was sub 10% for the first time in quite a few years, adjusted EBITDA growth was at 12%. And if you look at the percentage of adjusted EBITDA divided by net revenue, which we consider to be our value add, you'll see that the EBITDA conversion, as we refer to it, which was around 48% in 2022, 86 million divided by 178, tipped over the 50% mark in 2023. 96 million divided by 190 gives us 51% EBITDA conversion. And now that we've got over 50% EBITDA conversion, adjusted EBITDA divided by net revenue, our task, responsibility internally is to ensure that we keep the business honest and ensure that we never dip below the level of 50% EBITDA conversion again. So for every $2 of net revenue we generate, the business should be banking as adjusted EBITDA at least $1 of that. The split of revenue into the two segments I won't go into too much detail on, because I've talked already a little about the fact that although online marketing at 14% higher year on year looks quite serviceable, that is actually the lowest growth rate online marketing's experienced for some years. So that is indicative of a business that is facing quite challenging market conditions. So when market conditions, advertiser competition, consumer confidence, macroeconomics generally recover, one should see upwards of 14% this year and in future years. Whereas the online presence sector, we have to be quite candid that 16% growth for online presence is a particularly good year. Online presence, the domain name, the germ, the legacy Centronic business, the domain name business, that 16% is actually the highest level of growth that segment has experienced since I've been with the group. So 16% is quite a success in that speed of business, whereas 14% shows some work still to be done in online marketing. The last thing I'll say, conscious that I'm running out of time and running into question time, bottom right-hand corner of the screen, just to show that it's not all things going in one direction all the time. We experienced a manageable increase in net debt during 2023. We had delevered quite a rapid scale during 2021, and especially in 2022, we delevered so that we reached a level of $57 million of net debt at the end of 2022, which for an ad tech business, and indeed in the domain name business as well, and particularly because we're competing mainly with US-listed groups, that 57 million was considered to be quite a low level of leverage, and we achieved, for the first time in many years at the end of 22, we achieved a less than 1 ratio of net debt compared to adjusted EBITDA. So 57 million compared to 86 got us under the 1-to-1 mark for net debt compared to adjusted EBITDA. And even though we've had a managed increase in net debt during 2023, which I'm happy to go into more detail later as to why the net debt increased, we still kept under the 1-to-1 ratio of net debt to adjusted EBITDA. You'll see that net debt is still lower than 1 year's adjusted EBITDA. So for us, even though we've had an increase in net debt, which we've been quite comfortable, and our interest cover on that debt is very easily serviced, it's important to us that we remain within at least a 2-to-1 ratio of net debt to adjusted EBITDA. So the fact that we're under 1-to-1 at the moment is still quite pleasing for us. And having said that's it for the financials, we should get into question time.
Excellent. Thank you, Billy. So I'll open up for questions. If we have any questions from the floor. Question there.
So how dependent are you on external forces such as if Google changes its terms or if there's more privacy laws coming out? How would that affect you?
Well, the changes that Google might bring about to us, they're generally not a problem for us in our largest revenue stream. So in our largest revenue stream, we're providing traffic to Google basically as an aggregator of advertisers. So when Google changes its algorithms, which is the change that typically gets a lot of press, that doesn't impact our main revenue stream at all. It does have an impact for one of our other business models that we haven't had time to go into, but there's a business model we have that is just under 10% of the business at the moment, and that's a business model under which we actually acquire traffic from search engines and we deliver to e-commerce companies such as Amazon.com or eBay. So it's a complementary business model to the main business model of search. In that business model, when Google make algorithm changes regularly, it does impact that what we call the comparison business. So I can't claim that Google changes its algorithms doesn't impact us at all. And indeed, we have seen that with Google changing its algorithms in an unprecedented volume of times during 2023, it has impacted that comparison business and kept it at less than 10% of our business. But generally, we are fairly immune to Google's changes. They don't make a material change. As that comparison business scales, then we will be more susceptible to changes in Google's algorithms. But right now, Google changes its algorithms, and it doesn't stop us growing. But in the future, it is something that we're going to need to continue to stay on top of.
In previous, you've done takeovers of other companies. Is there any on the cards at the moment, or is this something that could happen?
Always, absolutely. Whilst we made a statement that we changed our strategic direction slightly in December 2022, and we raised the bar in terms of what multiple we're prepared to pay to acquire businesses. And in the aftermath of that, we've only made one acquisition over the last year, which for CentralNic was very unusual. CentralNic, certainly over my first 3 years with the group, 2019 through 2022, we were acquiring businesses and adding completely new business models and new platforms and new divisions. We're no longer in the business of adding completely new revenue streams. Where we're still interested in buying new businesses is where we can acquire businesses that are, for one thing, immediately earnings and cash flow accretive. So we're very fussy, and we won't buy businesses that are in turnaround or that will need extensive restructuring and integration work. We will only be interested in buying businesses that we can integrate quickly into an existing business model. And we can talk in more detail about M&A, but to give the straightest answer to your question, there are targets we're always looking at, and it will be very unusual for CentralNic/Team Internet to go another year or another 2 years with the very sparse level of acquisitions we've had in the last 12 months. So there are businesses we're interested in.
And you pay a dividend, don't you? Yeah, sorry.
We declared and paid our inaugural dividend. So as opposed to some of the other speakers tonight, CentralNic did not pay a dividend at all in its first 10 years as a listed group. I remember distinctly when I joined the group in 2019, it was being discussed at the board level. I wasn't on the board at the time. And there was hot debate about 2019, 2020 being the first year when CentralNic would declare and pay a dividend. COVID ultimately put paid to that in that there was enough nervousness amongst the board and in the investor community where that plan was shelved. Myself and the group CEO remained keen to declare and pay a dividend, and eventually in 2022 we determined that we could we could launch a progressive dividend policy. So we launched that progressive dividend policy in Q2 of last year, declared and paid a dividend of £0.01 a share, and the idea is, and we're fully committed to this, and indeed we've reached the time of year now where we're finalising the level of dividends that will be paid out in Q2 of this year. That is a truly progressive dividend policy. It won't stay at £0.01. We will never fail to pay a dividend. It is something that's now, we need to make sure it's part of the company's DNA. So we're genuinely looking forward to announcing to the market what the new level of dividend is going to be for Q2 of this year and progressively thereafter.
That's good. Thank you.
Any more questions? Just
who do you regard as your biggest competitors?
There's a couple of companies that we look to quite closely, and we know the exact competitors in our largest business model. We could talk all night about competition in some of our smaller revenue streams, and perhaps we'll have a bit of time afterwards. But in the largest business stream we've got, which is the Tonic and Parking Crew, 67% of the business, there's a group that's listed in the US. They're called System One Group, not to be confused with the System One Group that's listed here in the UK. System One Group Inc. is listed in the US, and they are, we believe, our largest competitor. One massive health warning, though, about going and looking up their shares is you will see that their share price performance, over the last year or two has been pretty challenging. So I wouldn't take that as an indicator that there's anything within our industry as a whole that is problematic. They've had two particular problems, System One Group Inc., that we haven't had. One is they've been highly over-levered, and therefore they haven't been able to reinvest in their business and platforms. We're quite moderately levered for an ad tech business, and therefore we've been able to reinvest, and we throw off a ton of operating cash each year. The other problem they've had is that we've been stealing their market share. So we have unfortunately been one of the creators of the decline in their share price. There are two other listed peers that we look to. The CEDO segment of the German listed group IONOS is a good peer to look at, and then there's also a company called OB Media. But then after those three competitors, the industry tends to tail off. There aren't many companies that do exactly what we do, mainly because Google handed out these licenses to provide traffic to them, and because the quality is so important, the last license they handed out was to us 13 years ago. They haven't handed out a license since. They haven't changed the terms under which we operate since. So between us and OB Media and System One and Sedo, they're the companies we tend to look at.
What flavour I'm thinking of is that nearly all of your customers, certainly the ones you've mentioned, are large American corporates, correct?
Yes.
Yeah, the Googles, Facebooks, etc. Does that worry you that, you mentioned your major competitors are US based?
Yeah.
Their customers are big US based customers. Is that a weakness? Is that a threat?
It hasn't been a weakness for us because so taking any of the really big business partners, Google, Amazon. So let's take Google, Amazon, Facebook. Although they're US listed, they are global businesses. So our biggest check that's cut to us every month is from Google Ireland. Google Ireland runs Google's European operations, and they pay us literally in excess of $80 million in excess of $70 million every month. So the fact that we happen not to be listed in the US, although it makes us slightly unusual for an ad tech group, it's proven to be a benefit really, because we can compete with the likes of System One on their own patch, but they can't compete as effectively with us in other countries outside the US. So as Martin alluded to right at the top of the presentation, the Americas represents 51% of our revenue at the moment, but we're growing at a faster pace outside the US, and we're keeping pace with System One in the US. So at the moment it's an opportunity, but I wouldn't claim that we're complacent about the need to stay close to, one of the reasons we report our figures in US dollars is so that we're, both from a trading and from an investor point of view, that we're able to access as broad a range of investors and get the message across consistently with those US peers. So as long as our investor outreach continues at the same pace, and as long as we get the name out there and the business understood, we should keep winning that fight against those competitors.
Thank you. Thanks.
Thank you very much for the
Thank you.